Hey everyone, welcome in to another daily editorial here on the KE Report. Corey and Chad here chatting with Matt Battiali, editor of the New Energy Investor newsletter, which is published under the Mangrove Investor website, which is where I'm going to link to below this interview. Now, Matt, we were, as always, coming up with topics to discuss when it comes to critical minerals and that overall narrative that is continuing to be on a lot of investors' minds. We chat with you about every 2 weeks about it. And you brought up the fact that we should probably touch on this Inflation Reduction Act. I took a lot of time yesterday afternoon reading through a wide variety of sources that break down what this Inflation Reduction Act is all about. Now, I don't want to get political with this because, boy, oh boy, this can get very political. I was shocked with how many different articles I read, depending on which side of the aisle really funded it. They came up with vastly different outcomes, vastly different projections. I want to stick more to the money that is being allocated towards different electrification metals or the electrification narrative that is continuing here, this whole going green, because quite frankly, this Inflation Reduction Act, it is putting a lot of money into renewables, grid energy storage, even nuclear power, electric vehicles, all these different avenues that investors have been interested in. Matt, how are you going about filtering through the noise from an investor standpoint to see which metals, which areas of this whole green transition are going to benefit the most from this Inflation Reduction Act?
Thanks for having me back again, you guys. A recent study caught my eye. And like you guys, this is right up against the edge of way too political for me. But what I noticed in a couple different places was the kind of the boom that's happening in domestic manufacturing of batteries. In Canada and in the States, there was a quote that caught my eye. He's the senior principal of the Rocky Mountain Institute. The guy's name is Aaron Brickman. And he said, the United States is effectively now the most attractive destination for global capital in clean energy and clean tech. Now, that's saying a lot because, we know when you look at North America versus Europe, the Europeans are way out in front of us effectively on, adoption of clean energy and electric vehicles. But we also know that China has really been the home of clean energy and clean tech investments. That's where all the batteries have been made. That's where all the metals are refined. And so I just kind of ignored this, this thought until recently. So between Brickman's quote and a recent study by Goldman Sachs, which showed that the amount of money coming into the U.S. and in North America in general is several times more than expected, I really had to sit up and take notice. I mean, when this Inflation Reduction Act was passed a year ago, the Congressional Budget Office expected kind of the electric vehicle tax credit to generate about $14 billion in tax savings for folks who buy electric vehicles. That's a good number for politicians, but in terms of forming investment ideas, investment theses, that's 14 billion over 10 years it doesn't get me excited. But Goldman said, hang on a sec, in just a year, we figured out that it's not going to be 14 billion, it's going to be almost 400 billion. So $400 billion implies a massive amount of purchasing of electric vehicles. And that's just in the States. So now I'm interested. That's the sort of thing that kind of gets me excited. And now I want to look at investment potential in this space. And there's a lot of investment potential. And Corey, you said you did a lot of digging. I mean, one of the things that caught my eye and kind of really surprised me was in the last year, the number of battery manufacturers that are planned and some of them have even started construction already in the States, in places you would never expect someone to invest in a factory. We joked about California is getting a Tesla plant. Nevada is getting a Tesla plant. Texas is getting a Tesla plant. When you look at the companies that are building battery manufacturers, these are big, real companies. These aren't. This isn't Corey and Chad's battery manufacturer. It's LG. It's BMW. It's Honda. It's Ford. It's Tesla. This is crazy how much it's happened in the last year. The downstream implication that I take away from this is that we want to own a basket of these companies. We were talking about ETFs earlier, and I know we'll get to that, but I think it's going to be hard to play this with a single stock. I think this is going to be a basket investment idea. So I'd like to get your guys' take on that. How do you think we should play this?
Well, Matt, I'm glad that you brought up Corey and Chad's battery company, because we are here to announce that we are going into the KE batteries plant, and we're going to be building one. No, I think it is interesting to look at just the sheer number of plants being built in the U.S. and Canada. And I may actually dive under the hood a little bit further with you, Matt. Just lay out not just those Tesla plants, but just how many plants are going up in the U.S. and Canada from LG Chem and Panasonic and all these manufacturers, and maybe how the manufacturers are taking a leading role in also sourcing these materials from the from the raw materials on the upstream from the mining company. So it's not just that these manufacturers are building battery plants; they're getting involved with the whole supply chain.
They are. It's Tesla has been kind of the leader with that, with their offtakes. LG Chem, I know, has an offtake agreement with a group called Piedmont Lithium. There's a new company, Sayona Mining Limited. I hope I pronounced that right. It's a Australian listed. They took over North American Lithium in Quebec. These guys are in production, and they're going to be selling to LG Chem. I think there's 30 new gigafactories that are being built in the United States right now. And it's crazy. I don't know how many states it is, but when you look at a map, it's really impressive. I mean, Florida, Georgia, South Carolina, North Carolina, Tennessee, Indiana, Ohio, Michigan, New York, Minnesota, Texas, Nevada, Arizona, and California are all getting plants. And these are big plants. And then when you look in Canada, there's a pretty significant investment in Canada as well. I mean, they're number 2 in the world for lithium ion battery supply chain. They're number 4 globally for raw materials. They're a top 10 producer of nickel, cobalt, graphite, and aluminum. And so it makes sense that you would put battery manufactories, if not in Canada, adjacent to Canada on rail lines or infrastructure routes that they can get the material to them. One of the interesting things to me is that I think one of the first and biggest battery recycling facilities is in Canada now. So that's really interesting. These guys have a massive EV battery recycling system set up where they collect in large cities and then they refine it in, I believe it's in Toronto. I think that's really interesting. So you have kind of source all the way from the mining all the way to the recycling. And then you have the demand side, which is just massive right now. And a lot of that is being encouraged by that Inflation Reduction Act benefits. I mean, when you go and look at the long-term investment from the Inflation Reduction Act, they issued $2 billion worth of grants, $3 billion for zero emission equipment. The list is long. I mean, it's easier to just go and check it out for yourself. But when you have this sort of support, it's basically guiding the economic fire hose. So that's why I think we want to invest alongside this.
Fair enough, right? Follow where the cheap money is being allocated. But Matt, when it comes to those investors that are focused on the underlying metals, these critical metals, saying, look, there's a lot of money being placed into this sector. It has to filter down and it has to lead to higher metals prices. Do you agree with that? Or do you think the money very well could get stuck with these large companies that are building these factories that have a lot of expenses initially, and then it's up to those larger companies to filter or trickle that money into some of the actual metals companies.
Look, these guys are building things that are metal intensive. Let's use Mercedes for example. So this is a really interesting investment. Mercedes plans to invest billions of euros to build 10,000 fast chargers in North America. So there's a car manufacturer that's going to build charging points across Canada. They're doing 2,500 chargers at 400 locations, and it's going to happen by 2027. So you can't build these things without a significant amount of copper. There's no substitute for it. So this is an additional demand, and it's a small demand, but it's significant in that it's an example of something that we've never seen before. I don't ever remember Mercedes building gas stations in the States, right? But they're going to be here, and they're building these charging points. When you think about the volume of metals that are required to build an EV battery, and then you look at those 30 new gigafactories, and they're called gigafactories for a reason. The volume of energy in batteries that they're going to create is huge. I mean, when you look at the Tesla plants in Nevada, they're 44 gigawatt hours per year. That's a lot of batteries. And so that's a lot of lithium. It's a lot of copper. It's a lot of graphite. So I don't think that I certainly think that by buying forward, by setting up your agreements now, they're going to lock in good prices. But I think on the margins, what controls the price is the people that have to buy in the spot market. And yeah, you can't add this much demand. Certainly not demand for domestic metals, right? Without driving the prices up. You just can't.
Well, and Matt, for somebody listening to this discussion, a lot of the people on this call or listening to this recording will be in the resource space and looking at the critical minerals. But there's also, as to Corey's point, a lot of money that's getting filtered out at the manufacturing level. All those companies that are building the charging stations, that's a whole other angle. And there are ETFs that group a lot of these different kinds of raw material companies, manufacturing companies, technology companies together. Any ETFs that you could throw out there for investors that may just want to take that basket approach?
Yeah, I do think that's a great way to play it. Obviously, these EV battery makers and the car manufacturers are going to benefit significantly, and there are lots of these ETFs. I mean, I was looking at one. It's the Global X Lithium and Battery Tech. The symbol is LIT on the New York Stock Exchange. And it holds companies like Albemarle, Rivian, Tesla, Panasonic, BYD. That's a great way to play this uptrend. The shift in kind of power source, right? The shift from gasoline to electricity. There are many other ones, out there. The DRIV, which is the Global X Autonomous and Electric Vehicles. ICLN it's a global clean energy ETF. I mean, I think you guys had some cars, the Crane shares, KARS on the New York Stock Exchange. I think you guys had some ideas on this as well, right?
Oh, there were a handful of them out there, Matt, when we went through them. And some of these ETFs, too, were even encompassing totally outside companies, too. So I think you can tell that there is an interest in this sector just by how many ETFs are.